Thank you everyone for joining and welcome to the Sifted Talks on US expansion and sales tax in partnership with Vertex. So my name is Mimi Billing and I'm the Europe editor at Sifted. And well, we're going to talk about obviously that startups are, even if Europe is fantastic, they're still looking to the US to expand. And what people might not know is that every state has its own set of tax laws and tax nexus. And thankfully, we have a great panel here to discuss both the kind of expansion plan and how to do that, and also how to deal with those kind of tax issues. So I'll just say welcome to my great panel, and I'll start to introduce Larry Mellon, who's the tax director at Vertex. And Larry, I mean, he has over 30 years of experience in sales and by using tax compliance, risk assessment, jurisdictional audits, administration management, as well as VAT compliance. So good to have you on board. And also welcome to Emmy Nygaard, a partner at Ernst & Young. And Emmy is a partner in the indirect tax transformation team, leading the VAT technology pillar at EY, UK and Ireland. And you have more than 18 years experience with this across, tax technology, tax engines, data analytics, compliance solutions across the world. So great to have you with us, Emmy. And I'm turning to Viraj Bosle, investor at Jamjar Investments. And Viraj is an investor at this £100 million early stage consumer fund that invested in Deliveroo, Papier, and many others. And prior to Jamjar, he worked on the international expansion team at Revolut, which is going to be interesting to hear a little bit about that. And last but not least, welcome to Hal Orrell, Finance Director US at Babbel. And well, you are focusing on revenue and marketing for Babbel, and part of your responsibilities is considering tax impacts for the US market for the Berlin-based company. And prior to Babbel, Hal was the VP of Finance at Datalot Inc. So, welcome, all of you. Long introductions, but now let's begin. Let's get this rolling. And to start off with, I mean, I think I just gonna turn to you, Viraj, because obviously with the kind of experience of Revolut and now as an investor, I mean, is the US still this kind of space where people in Europe should go to and where investors want their startups to go to?
Yeah, it's a good question, Amy. And I think the boring answer is it really depends on each individual circumstance, as I'm sure you can imagine. We like to think about what stage of the business they're in and how that kind of aligns with their other priorities at the time. One of the things we often see is companies identifying US expansion as a key priority, maybe a bit too early on. It's obviously a massive market and it's easy to see the dollar signs, but it's also so difficult to get right. And we like to see a company that's thought through the risks rather than deciding to expand just because it's a huge market, right? I like to kind of think of it as like a chart with impact on kind of the y-axis and like your effort on the x-axis, and so in the US, impact is obviously usually very high. There's a huge addressable market there, but it's also one of the hardest markets to crack. It's often got the most advanced regulation, as we're about to hear about. It's incredibly expensive to acquire customers and talent, incredibly competitive, culturally very different. And so you have to really think about, maybe launching another product in your home market or launching another country in Europe makes more sense. It's really about how it aligns in priorities of the rest of the business as well.
Okay, so if you turn to these companies that you actually believe should go to the US market, then, I mean, are there any specific fields like that's easier? I mean, obviously like online sales maybe, or like, what do you think?
Yeah, I think less regulated markets tend to obviously be, I think, a little bit less difficult. I think they're all very, very difficult. I think coming from Revolut, which was, in the fintech space, which is very, very highly regulated, I think there's a lot more to consider. And so I think it definitely tends to be, easier in markets where there's less regulation in place, especially because the US is at the forefront really when it comes to regulated markets.
Sure, sure. And if I turn to you, Hal, I mean, you're at Babel. This is obviously a Berlin-based startup, but you're in the US. I mean, how has that kind of expansion gone for you?
Sure. I would say I want to piggyback off what Viraj said, is that Babbel, we didn't just jump right into the US market. You know, obviously it is a big market, it's a large addressable market, so people get dollar signs in their eyes and they want to go after it. But what we did was we built up our product to make sure that we had a good, solid product to offer the market. We expanded into the US more organically rather than jumping in and trying to grab market share immediately. So we were fortunate, you know, we're in the Apple store, we're in the Google store. We want to get into the US market. It's as easy as flipping a switch to actually get into the market. We saw that there was demand for our product. And then we made the conscious decision to really start trying to expand into the American market rather than force our way into the market.
Yeah. And just to the audience as well, if you have any questions to any of our panelists, please just use the little Q&A button at the bottom just to share those questions with us, and we'll pick them up during. Yeah, no, I mean, obviously we've seen lots of failures coming to the US as well, or not failures, but maybe it takes a long time also to maybe take that market. And I mean, is there anything that you can see, like, well, I mean, what should be the kind of key aspects to take into account when you are planning this kind of US expansion? I mean,
yeah, sure. It's definitely looking at the product that you have, and is what you are trying to sell, is there an addressable market in the United States, or is it already being filled by another product? So here in the United States, there's new companies, new products constantly vying for people's attention all the time. And so you coming from Europe, whether your product is successful in Europe or not, you're starting from ground zero once you re-enter into the United States market. So is there a place for your product, and how are you going to market your product to the audience? One thing we could say about Babbel is, in the European market, learning another language is part of the way of life. You know, you drive a few hours, you're in another country, you're speaking another language, and so you want to connect with these people. You're at schools, you're learning another language. When it comes to business, you need to learn English to expand your business. Here in the United States, it's not as functional, you know, for a person to grow, for a person's day-to-day life. It's more of a want than a need. So it's understanding, hey, if I go to the United States, how is my product going to be thought of there rather than how it's thought of in the European market? So it's not just, do I have a good product? Can I move it there? How am I going to find the market fit there? And how would people perceive my product in the market in the United States?
Yeah. Viraj, do you have anything to add there as well?
Yeah, so I kind of want to piggyback off that and just maybe add, it's kind of two big buckets and then sub buckets for us. On one side, as Hal mentioned, like localization and regulation is a big piece of that, right? So people tend to group the US as one country, but it's really like, you know, it's like almost 50 different countries and rolled into one. Each state has its own regulation that takes time, effort, and money to understand. And, you know, I think the others on this panel can do a much better job of speaking to the regulatory side than I can there. But it's also culturally so different, and how you speak to your customers, as Hal said, is fundamentally different. You know, I think to give you an example, we saw a D2C company try and move there with the same proposition that was working very well in Europe, which was, you know, maybe affordable pricing. And that messaging in the US attracted a very different type of consumer, sort of like a, you know, a deal hunter of a consumer that is maybe led by a culture of coupons. And this is much less pronounced in Europe. And so these customers end up behaving very differently, churning very fast, you know, and they end up exiting the market earlier. You know, another company we've seen is, you know, notice that the US customers tend to rely on telephone support a lot more than chat-based support. And, you know, again, you have to revamp your entire customer service team to deal with that. So I think there's lots of little nuances, both from like a regulatory side, but also like a cultural aspect that you need to be aware of. And then in the second bucket for us, I think competition, again, as Hal mentioned as well, one is competition for customers and consumers, but yeah, there's also competition for talent. So the US is also, you know, a much more competitive market. You have to ask yourself how you differentiate there. In our experience, consumer acquisition costs are much, much higher there, and so are lifetime values, absolutely. But you know, acquisition cost is very, very high. But there's also an incredible competition for talent. You're often competing with better funded competitors, and when you do find great talent, it's often a lot more expensive. So I think those are two things to really be aware of on the competitive side as well.
I
You've
think
kind of
two
had,
things, if I could comment on there, two other things too, is I agree it's flip side too. You talk about the expansion. It's also the culture of US trying to sell internationally too. They have to do the exact opposite flip with that. So that's a key point. So it's two-way street. And then also with getting the talent and stuff, I think that since COVID has kind of hit across the world, especially in the US, I can speak on the fact that you hired people that were local coming into your office. Now you can hire across the country and have that person that's working remote. So it's benefiting businesses to get talent remotely, but then there's people who are living in an area because they may be in industry specific areas in that part of the country, and now they may not be able to find those roles because they're pulling talent from all over. So it has both sides of it. I just wanted to comment on the US side for that.
yeah, but also nice not to have to get your talent all from like Silicon Valley, because I suppose they are more expensive as well.
Yep.
That's great. And I mean, so when going to the US, this is maybe a stupid question, but I can see all these companies going to like creating like entities in Delaware and so on. Do you need that to be able to operate in the US? How?
So it depends on what your goal is in the US. If your goal is, if you're in e-commerce and your goal is to sell a product in the United States, you actually don't need physical presence in the United States. You need to let the government know that, hey, you're here, you're selling a product, get a tax ID in case you need to pay any taxes, but you don't need an establishment in the United States. And in fact, a lot of companies try to avoid having a permanent establishment in the United States. So your international revenue and your international income isn't necessarily up for grabs in the United States. You kind of want to keep that separate. So you don't actually need a physical presence in the United States if you want to move over. Now, where you see a lot of companies creating a subsidiary in the United States is to avoid that permanent establishment. You set up a new company in the United States, and that company runs independently. And so that company will pay United States taxes. And however that you set up that company to earn income, most likely not selling your product. Maybe the company is there just to market. Maybe the company is there just to produce. But you get your presence there, but not necessarily your liability, your tax liability doesn't necessarily grow with it. So that's a very important thing when moving to the United States. What are you actually trying to, if you create an establishment in the United States, what is the point of it? And what jobs are you trying to bring there as well?
Okay, interesting. And I mean, this is obviously, you mentioned tax, Hal, and I'm like, so what is the difference between like European taxes and the US taxes? I'm turning to you, Larry, first of all, and like give us like an understanding here.
Well, we discussed. I mean, there's certainly differences in tax because one, it's a value added tax, right? Where in the US, it's a sales or use compliance consumer, consumption tax, different words that you can use for that. But, you can look at a business that I would say internationally, and you're basically paying tax. There are certain areas that are recoverable and you're able to take that money back, 1 month and you get it back the next month or quarterly, whenever you're filing. In the US, you pay sales tax, that's it. It's not coming back. So you find in the US that there's various regulations on what tax rates are, where you could look at, somewhere in the EU or a country that's in there that has a flat but a higher, say a 20% tax. You don't see that in the US. There are some states that are up around the 10, 11%, but most of the states are a lower sales tax rate that are administered by each of the states. So there's 45 states of the 50 that have a state tax rate. Some have county level, city level, district level, that are all able to be imposed by each of the jurisdictions within those states, and they can impose what is taxed, what rates are being charged. So to the point we're saying, it varies. It's not just one. There is no federal sales tax rate. It's just being done and administered at each of the states. That's just kind of an overview of what the difference between the two taxes are.
Yeah, and I mean, how do you? Yeah, sorry, Hal. No.
I just want to say one important also difference between the VAT tax that you see in the EU and the sales tax in the United States is how it's collected. Meaning that if I sell a product for 10 euros and there is a 10% VAT tax, I'm still charging a consumer 10 euros and my revenue is around 9 euros. In the United States, the sales tax is added on top of the price. So you will still sell the product for 10 euros. You will bring in the 10 euros, but then the consumer will pay the sales tax on top of that. So that is also a big distinction between the EU and the United States, especially when you think about pricing and your product that way.
Yeah, I mean, good point there. So it's a hidden cost for consumers.
Yeah, it's hidden, but it's very weird that we don't include tax in the sales price, but we all know it's there. It's like this game that we all know it's happening, but we all pretend like it's not.
So how can you? Sorry.
Yeah, just for those purchases that are subject to tax.
Yes, yes.
So it's not across the board. There are far less things taxed in the US and far more things taxed in the EU, UK, and other VAT countries.
Okay, so if the sales tax is put on top of the price, does that mean it's less administration for the companies? Larry?
No, I don't think it's less administration. I think it's, that's the role of the tax department, is to ensure that on the sales that you make and the purchases that you make, both sides of that accurate tax is on that, whether it be should it or should not it be taxed. Is the rate assessed accurate? And then the remittance that you're making from as the seller to the jurisdiction has the appropriate tax, sent to the jurisdiction.
I would also add that, one of the things we talked about was, Larry brought up was that, there's 45 or whatever states, that are taxing this way. There are also 45 states that are collecting tax. So you need to be able to file, you need to be able to do compliance in all of those states. You need to have a working knowledge of how all of that works. So there is complication in that as well. And we see not just getting the tax right at the time of, sales and purchases, but also the compliance is a piece where our customer, like my clients, definitely need to think about that as a strategy going forward as well.
So what happens to the other 5 states? Do they not actually have any taxes?
So every state has their own way of generating revenue for their budgets. Some states rely on sales tax, some states rely on income tax, other states may rely more on property tax. So every state has their own way of generating their revenue for their governmental expenditures. For those states that don't charge sales tax, that's just not the way they want to do it.
Okay.
Right. Okay. Some of them are making more money on the income of the individuals that are there. We're finding more and more states are eliminating or reducing the income tax, and they're increasing transaction tax, because you as the individual know that you make X amount of dollars per year and they're taxing your income. But if we were to turn around and charge 0.5% more on sales tax, you wouldn't realize that. You wouldn't recognize the amount of revenue that gets in there. So jurisdictions tentatively, often, once in a while, change those rates to increase to get more money in, knowing that they may not be charging as much on income tax.
Yeah, well, that's a big difference to obviously Europe. You could say. And Emmy, if I just turn to you about are there any kind of tax management tools? Because I suppose there must be loads out there for managing this kind of thing, because it's not something you do manually, right?
Yeah, no, definitely not. So that is one of the things, the US has probably been a pioneer in creating technologies to help customers and clients deal with this kind of thing. And you know, we've talked about all of the states that have this and all of the various levels that Larry mentioned. And Larry, keep me honest here, but I think it's somewhere in the realm of 58 or 5,900 taxing jurisdictions throughout the United States. And that varies year on year and different projects that are going on in different cities and states that are being funded through the sales and use tax. But, you know, keeping track of all of that and managing that, and to Hal's point about, you know, do you grow and how do you decide what states you go into, and growing organically and all of those things, you still are going to have to deal with, you know, the taxes in those jurisdictions as you meet the requirements of each state. And I saw a question come in around, you know, how do we know the thresholds and all of those things? It varies state by state. So that's actually something that, you know, people like myself at EY, not myself, but other people within my organization, you know, definitely help clients with, because you need to understand what your footprint looks like, where you might have registration obligations, or at least, you know, reporting and remitting tax. But the technologies have really been at the forefront, and we're sitting here with Vertex on the line. So, you know, I'd be remiss if I didn't mention, you know, that they've created a great tax engine and have a long-standing history in the United States of, you know, serving clients in that way. But all that does is keep track of those rates and rules, product taxability that we talked about, all those jurisdictional changes. I love the fact that, you know, the ZIP +4 changes and the boundary lines change pretty much daily, it feels like. So, you know, really keeping track of where taxes due, how you calculate it, who's charging what are the, you know, rules. In the US, you have things like, you know, basically, is it going to be taxed where my customer's using it? Is it taxed where I have a business set up, et cetera, et cetera? So all those rules and regulations and logic are managed by tools like Vertex O Series. There are compliance tools on the market. Vertex has one as well for the US and the rest of the world. I shouldn't say that an engine. So I do a lot of work with engines in Europe and the rest of the world. But I definitely got my start, you can tell probably by my accent, in the United States. So, you know, very akin to this. But technology is evolving, and it needs to, because this is changing. But most, I'd say 99% of customers in the United States will look to some sort of technology to help them manage this. Otherwise, you're really going to struggle.
And what happens if? Sorry, Larry, do you want to jump in?
Yeah, I just wanted to comment that, like, we were talking about these changes. I know that for like we said, different levels, state, county, cities, districts, where they said, I know that there were, in 2023, there were 154 new districts set up in the US. So this is just a jurisdiction that said, we are now going to impose a tax because we want to build a road. We want to do whatever. They put a tax in, they have that ability. So now, to Emmy's point, you have to determine, am I located in one of those areas? Did I meet that threshold? I don't even know that they imposed the tax. Like, so there's a lot of work that has to go. And that's where an EY is stepping in to say, where do I have my exposures? Did I hit a certain threshold of sales in one place? Can my tax engine or my you know, outsourced vendor help me determine these things? So all these things kind of play in for US. I always talk about the difference of tax, and I've always used the Kit Kat as my example. Right. So most people look at as a Kit Kat as like a candy bar, right? But for the US, in some states, it's a candy bar. In some states, it's a baked item because it's a wafer covered in chocolate versus it being chocolate bar where it's chocolate. So all those things add up to where one state, county, city could tax it differently. And that's what's unique about the sales and use tax side in the US.
So
Yeah,
what happens? Yeah.
I was
Sorry,
going to say, that's your version of a Jaffa cake, Larry.
Right.
The
Yeah.
US
Right.
version of,
There you go.
in Europe, everybody knows that a Jaffa cake has a whole different VAT treatment. It's weird.
Right. Yes, it is.
I can tell you that probably most Scandinavians do not know what Jaffa cake is.
Yeah.
but if you happen to, well, fail to pay the right taxes in each jurisdiction, what happens then? I mean, are they kind to you? They're like, well, you know, just do it right next time, or will you be kicked out, or what happens?
So when you do your compliance, you're certainly, you know, in most businesses will come under a state taxing jurisdiction to ensure that you've done things correctly. If you're starting up a new company, you may be years and years and years before you're audited. Generally, when someone is to be audited is because something else triggered it. Either a supplier or a vendor that you're using, they've triggered the audit and they're like, okay, who did you sell to? Who did you buy from? And that's what generates the audit back for you. So they would certainly discover what was incorrect. Was it that you did or did not tax it? Did you tax the incorrect rate? And then they would then assess the tax that is due for that, under that audit period, which in most US states is a 3 or 4 year period. They would understand and assess that tax. And then you then would certainly go back and change your decision on how you tax those sales and purchases so that you don't insure it the next. You're not being kicked out. You just pay the tax and a penalty for not doing it accurately. And then they'll come back in 3 or 4 years to make sure you still did it right or get more money from you.
Okay. Has that ever happened to you?
Yeah, so my previous job, we were audited at sales tax by New York State. And I think the big point of what happened with our audit, and it's something that Emmy and Larry both brought up, it's important to have a tax expert here in the United States or consultant to really help you with these issues. Because if you have all of your opinions in line of whether you owe sales tax, whether you don't owe sales tax, what your product is, how you're going to describe it to the state. All these things are very important parts of these audits. So when the state comes in, you have all your documentation ready, and you could tell them maybe why you didn't pay sales tax, why you think you don't owe sales tax, why you started paying sales tax at a certain point. So the important part is having your documents ready for the state for when they come in. And if the state comes in and they find that maybe you owe some sales tax or you owe some use tax, I know we're going to get into the difference between sales and use tax, you just pay it. There's a penalty on top of it, and then you move on. So that is one of the positives about working in the United States. If you happen to find out, hey, I owed sales tax and I wasn't paying it, you just pay it. And then the state's like, thanks for the money, and keep doing your business.
Yeah, exactly. And we did speak a little bit about sales and use tax. That was the one, right, Larry? You mentioned that before, or? Yeah. And I mean, Viraj, I was just thinking, because you're obviously an investor and you see lots of European companies come to the US. I mean, how often do these becoming problems for you, for the startups that you invest in?
Ooh, it's a good question. Fortunately, I don't think the portfolio companies are coming to me about their tax-related issues, and so I don't know too much about how much of it is an issue, at least how much this specifically is an issue. I know local regulatory nuances is definitely a pain point. I think coming from Revolut as well, we definitely saw that. But in terms of our portfolio companies right now, it's hard for me to say. I don't think I'm their first port of call when it comes to tax concerns, unfortunately.
And if you don't mind adding a little bit more color, it also depends on what your business is doing, how the chance the state may reach out to you for an audit. A lot of businesses could fly under the radar, under the state. Let's say you're in e-commerce, you don't have presence in the state, you don't have any employees in the state, you're just selling something online, you're not this huge company that's in the news. You may fly under the radar. And another thing is, if you're paying sales tax, if you're just paying the sales tax, a lot of times the states are like, oh, we're getting revenue. Maybe they're not reporting everything. We don't know, but I'm not, you should pay what you owe.
Easy, hell, easy.
Pay what you owe, but there's a lot more forgiveness. It's not like the states are out looking at every single company who's ever sold anything in their state saying, hey, we're going to audit these people. While an audit can be something that occurs for your company, it's not guaranteed that's going to happen. So the fear of the audit shouldn't stop you from moving into the United States. It's something that happens to way less companies than maybe you would think.
Okay.
Right. And just to add on to what Hal's saying, remember I said earlier, what often triggers the audit is the vendor that you're selling to, or or the person you're selling to, or the person you're purchasing. That company's looking at who you're buying and selling from. That could trigger. But no, I would agree. You don't want to stop your expansion of fear of audit. You want to, if that's your dream, you want to build it, you should not be fearful of audit.
So Larry and Emmy, I was thinking, like, because you obviously worked in so many different I mean, both in Europe and the US and so on. I mean, is the auditing harsher in Europe, you would say, than in the US then?
I would say I think they're somewhat equal, if I'm honest, from what I've seen. And again, you know, I'll be keen to know what Hal and Larry think on this from their perspectives. But I think they're similar, if I'm honest, Mimi. But what I've seen is that in like for the UK, for example, I've seen my clients with really, really strong relationships with, say, HMRC. And the ability to kind of manage that in a slightly different way than you could say with the state government, you know, state tax authorities in the US. I think just by virtue of probably size of the market, number of people that they're looking after, et cetera, I think the relationships here can be slightly deeper. And I say here, meaning the UK, where I'm, you know, based. But again, I think they're looking for the same thing. And to Hal's point, there's a lot of those that fly under the radar because they're just paying their taxes, they're doing what they need to do, and they're not really the ones that they're looking at. So I've seen it be somewhat similar, but I don't know, Larry, if you have a different opinion.
No, I would agree. But remember, you know, as you look at this, it's also going to depend on that business. Are you a company that sells 500 products and now you have all this exposure on whether you've changed things, or you're a company that sells one or two? So it varies in your type of business. Plus, you could be someone who's been in business for 100 years doing the exact same thing and you've been through audit, your risk is low. Or you could be someone who has a company that has those same 100 products, but every 2 years you create a new product. Well, then your exposure is really only that new product, right? Are you taxing the same way you've taxed things that have been around for 100 years and then it's not on the radar? Are you changing how it's taxed, which then maybe puts you on the radar? So I would agree with Emmy that they each have their own uniqueness. And I think it depends on volume, size, company, industry, all that has a impact on whether audits would be increased or decreased.
We have some questions from the audience as well, and it was two here which run the same thing, and it's one from Rachel Sheridan, who's asking, are there platforms that are particularly good for smaller e-commerce startups to manage US market entry? I mean, what would you say? I mean, maybe not like, you know, this is not like selling something, but I mean, like, are there
So I am not endorsing any products. Let's just start with that there. But I will say for smaller startups that are starting, you're usually using a payment platform already, like a Shopify or something like that, to sell your product through. And there are platforms that directly connect with those platforms that make calculating and paying your state taxes very easy. Something like a tax jar is just top of mind. That is something that's plug and play with a lot of different payment platforms and a lot of different selling platforms that will easily calculate and then pay on your behalf to the states. So there's no paperwork you need to fill out. These platforms make it very easy to actually calculate and pay taxes in the United States. But there's many to choose from.
Yes.
Yes, we're pretending we are like public, you know, BBC or something here. There's many to choose from here. And it's another here from Keith Binding, and he's following on from Rachel's question. And how best should an EU-based company making the minimis online sales of products to US-based customers manage their US compliance obligations?
I mean, I would say find a vendor in the United States where this is their bread and butter. This is what they do. Obviously, you have the large companies like EY and Vertex that could really help you out. There's smaller companies you could go to as well. This is what these companies do. They will do the research for you. They will spell out for you where maybe you owe sales tax, or maybe you will owe sales tax later after you hit Nexus, which I think is a topic we'll talk about today. So you don't need to come to the United States to figure this out, read through all the tax laws and find out where I owe sales tax. There's consultants out there that this is what they do, and they will spell it out for you when you need to do it, what you need to do it. And some of them will either even help you do the applications go through the registration process, and do everything on your behalf.
So it's worth the money.
Yes, it's
Yes.
worth the money.
So we mentioned nexus here, and sometimes people talk about economic nexus, tax nexus. What on earth is that? I mean, Emmy, do you want to start off?
Yeah, sure. And Larry, keep me honest here.
Sure.
So listen, nexus is, your tie to a state, if you think of it that way. So if we think about it from a European standpoint, do I have a physical presence in a state? That's physical nexus. So to Hal's point, do I have an operation here? Do I have a business setup? Do I have employees, etc.? And again, I'm speaking about this in very high level terms. This is not specific to any one state. This is not everything you need to know. But we only have an hour here. We could talk about this for days. So you think about the physical side of it, that's probably slightly easier, though there are things that you wouldn't think that would trigger physical nexus or registration requirements or compliance requirements in different states, things like attendance at conferences, having salespeople on site, in a state for a certain number of days in a year, et cetera, et cetera. So there's lots of things that can trigger it. So definitely understanding that is important. Economic nexus is slightly different. And for most people, I'm guessing you'll be familiar with the Wayfair case, but this was all about people selling online into jurisdictions, into states where they didn't have a physical presence. They were just selling to customers, usually B2C, into those states and not collecting any sales tax for that state. And somebody said, I think it was South Dakota, said, wait a second, no, we want our money. And the Supreme Court agreed with them and said, you know what, actually, when you're selling into consumers here, if they were to buy it anywhere else in the state, they would pay sales tax on it. So you know what, we're going to allow them to collect sales tax. You have an obligation to the state. So different states have interpreted that differently and applied it slightly differently, because again, we have no federal mandate for how all this stuff works. But generally, economic nexus means that you are making sales into a state and at a level, whether that's revenue, gross, net, et cetera, whether that's within a year, whether that's within a certain number of transactions. And again, it varies state to state. You then have an obligation to collect and remit sales tax in those states. That's the long and short of it. Larry, did I miss anything that we were?
No. I think he got that really good. I think when we look at that physical, to your point, is it the brick and mortar, right? I opened up a shop and I have a brick and mortar. I have a physical nexus. Did you go into Los Angeles, California, and you're going to be there for 60 days doing something there? They may look at that and say, because you're standing on a street corner selling, you're at a conference for X amount of days, you've created a physical presence there, and now you have to register to collect and remit for the sales that you make in that jurisdiction. So then just to add on the economic side, basically Wayfair case 2018, everybody came through with a dollar amount of what's the word I'm looking for? Threshold dollar amount or number of transactions. And we're finding more and more these days since then, a lot of the states are doing away with the transaction. It's just more about the economic. So if you come into a jurisdiction and you sell $100,000, you're now required to collect and remit tax on that 100,000 and sales continuing from that point forward.
Okay. So Hal, yeah.
I just want to add one more thing to that. So we talk about nexus, and maybe your company has nexus in the United States because of a physical presence or an economic presence. I just want to bring up one point that Larry brought up earlier is just because you have nexus in a state doesn't mean you owe sales tax.
That's right.
It still depends on what you are selling. So that's why, again, a consultant could come in and just say, hey, guess what? You don't have to worry about nexus because your product isn't taxable in these 10 states. But in these 10 states, it is taxable. So that's another way how it can get really confusing. Certain products are taxable in certain states and not taxable in other states. So it makes it even more confusing.
Right.
Yeah.
But I want to just add here, just to remember this too, significant differences between products and services.
Mm-hmm.
We've been specifically talking about products. consulting service, advertising, all have different taxations too. So we've been using the word product interchangeable. Remember, there's a whole exact same taxation on whether it be a service over a product.
So, question for you, Raj. I mean, so when you are expanding to the US and you're thinking about like, well, should you try to like set these things up before you actually start like trying to get American investors on board? You know, when do you think is like the right time to do that?
The right time to bring in American investor on board, or when is
Yeah.
the right time to start looking at these issues?
Well,
both.
both. I mean, I suppose you start looking at this as soon as you start selling. But I suppose also, do you need to, someone actually sent a question, Sabine, if they should, if funding from US investors should be raised after having them, you know, after entering the market successfully.
Or before. Yeah, no, it's a good question. Yeah, I think ideally before, but that's obviously easier said than done, as you can imagine. It's an incredibly tough market to crack, and I think so, you know, any expertise or local know-how that you can get on board as early as possible is always helpful. And I think on top of the know-how, you know, US VCs come with them a lot more cash, and you know, given how expensive a market this is to crack as well, I think that cash is always helpful. But again, like I said, easier said than done. I think you can hopefully do something in between where maybe you start small, really prove that there is, you know, consumer demand, prove there's a clear-cut strategy to do this, and then approaching VCs once those two pieces are really nailed down. I think that's hopefully a useful middle ground.
Yeah. And do you think then that the VCs or the investors in the US, I mean, how much are they actually helping out with these kind of, I mean, you said that you don't really talk taxes to your kind of, but do you have a kind of a tax team at GMDR?
Yeah. So we personally don't. It really depends on the fund, right, and where you think your value add is, right? I think we're the kind of fund where we think you know, whatever value a VC says they're going to add, you got to divide that by 10 or 100. And you know, I think we know where our value lies, and it's very much on the branding and the consumer side. I think we're very open that, you know, if you're a fintech company, or when it comes to things like nuances like tax, there are experts like those on this panel that can really help you and do a much better job than any VC can. But I'm sure, you know, there are other VCs out there that have great expertise in this and can be very helpful. But yes, I think us personally, no, it's not something that we can add value, and we're very upfront about that.
Okay, good. So if I go back to taxes then, so I think we mentioned that it was like loads of jurisdictions and things are changing a lot. So how I mean, how often do they change, and how do you actually, do you have to have a consultant on top of your company all the time?
All the time. So I'll use it as an example. Someone who has like a Vertex product, right? We put out literature every month that says this is what has changed in the globe, right? We'll look and say this jurisdiction changed the rate up 0.5%. They now changed how this is going to be taxed. All that stuff is given to our customers every month that tells them what has changed, so that you then understand what has changed legally by a jurisdiction. But then you also, as the company, have to understand, have I changed the way I'm marketing my product, selling it, how I'm classifying it, how it's being used, to determine, has that changed the taxation that my company is set up to tax a certain way? And then you have to be able to make those changes on your own if you've changed it.
Okay.
I just looked something up before we did this on purpose for this. This is my ideal question, because it's one of the things I talk about for why a tax engine, for example, or technology is so important to this. So unlike in Europe, where we don't see VAT rates change all that often, though we did in COVID, it doesn't fluctuate too much and too often. You won't see massive amounts of countries changing at once, etc. I just picked a month last year, July of 23, there were 29 states that changed something about their tax rules where Vertex was monitoring this. It was in their system. So And that's just to give an example of, that's not necessarily common. It's not necessarily 29 or 30 states in 1 month, but we have things in the US like, sales tax holidays for schools and for going back to school and clothing and things that you need to, get your kids ready for that kind of stuff. And again, we're talking about physical product, but again, this varies across the board for multiple things. I'm just using it because it's an easy example from a US perspective, but we will see states change very, very quickly for very specific periods of time. And when I'm a systems implementer, right? So when I think about advising clients to get ready for that stuff, doing that in a system or being prepared for that or giving IT resources over to that and tax team time over to that, that's a big investment. And if you're sitting in, Europe trying to manage that for the US, that can become very difficult. So it's one of the things that we talk a lot about, which is that BAU. What does business as usual look like when that happens? So I happen to pull a good month, I guess. I just picked one because that's my birthday month. So I was like, oh, July. But yeah, so it was interesting to see that 29 states last year changed something in their sales and use tax rules in that month.
This is obviously, going to the US and expand to the US, we already know that costs a lot of money, more than maybe expanding across another country in Europe. So how much do these to keep track on all these taxes with consultants? How much extra do you need to put on top of your little bag of money that you're bringing with you to the US, or big bag of money, maybe? Is this something that you should really consider putting money aside for? Is that such a big investment?
I think it depends. I think it depends on what you're looking for from these consultants. Obviously, the first time you try to enter the market, they're going to need to do a lot of research on your behalf. So that first entry may cost a nice chunk of change. Depends on who's on the case, how much expertise they have to let you know where you need to go. Once you're set up and fully understand your landscape for tax in the United States, once you start selling, it's more of the maintenance. So the cost year over year isn't going to, it completely depends on what products you're selling, how big you are, but for the most part, when you're first setting up, that's where you're going to spend most of the money. Then year over year, it's more about maintenance. It's more of, hey, I need them to file these forms for me. Look, that's not going to be a huge cost. It will be a cost, but not a huge cost. I already have my sales tax set up to pay automatically. So you're not going to need to pay a consultant year after year after that. So it's really that initial cost where you'll pay a chunk of change. And then it's a much smaller recurring cost year after year after that.
And remember that sales tax piece that we're talking about. You charge someone $100 at a 6% tax rate. They're giving you $106 and you're sending $6 to the jurisdiction. It's not out of your pocket. It's not nothing from you. All you're doing is moving it from the person who's buying it to the taxing jurisdiction. You were financially not out any money when reporting that to the jurisdiction. So it's just to Hal's point, once you're set up and you have your operation, the sales tax doesn't cost you anything at that point. You're just facilitating the jurisdictional move of money.
Great. Good to know. And actually, I have one more question to you, Viraj. I think you're most suitable to answer from Rachel Sheridan again. So what are some of the most successful strategies you have seen for handling high US marketing and customer acquisition costs on entry?
Yeah, it's good. It's a good question. I think it's about really testing and iterating and starting small. So I think when it comes to a strategy, we think about. I think the first thing is we want to really make sure that and again, each fund thinks about this differently, but we tend to prefer companies that stay hyper-focused, right? So really nail your core product in your home market first. So want to see them really, really doing well, not just product market fit, but see them really taking off before expanding elsewhere. Then when you decided you want to expand into a new market, it comes to picking where you go back to this prioritization framework that I chatted about, which is, in this trade-off between impact and how big this market is versus the effort side of things. And so I think once you've then figured out where you go, we prefer really testing and starting small. So yeah, I think, trying new marketing campaigns on a small group, maybe it's a specific state or maybe it's a specific user cohort, really testing and iterating on that cohort before then expanding at scale, I think is the best way of doing it, right? Really, really focusing on identifying the key market segment you're targeting and then really nailing that down before you go beyond that, is kind of the strategy we look for.
Mm. And a follow-on question on this, because obviously there's a lot of expenses going to the US. I mean, apart from taxes and like how you'd, get those customers. I mean, are there any other expenses you think that you could cut down on a bit when you, expand to the US, and like, how do you do that in the best way?
Yeah, and I think the best way, again, goes back to that strategy, really making sure that you're making the right decision before you go, right? So first, making sure everything's working great in your home market, then starting off small and then expanding beyond that. I think one of the key things after that is making sure everything's working right in that key segment. And before you hire a team, I think, as I chatted about earlier, the team costs, and I think Howell knows, is very, very expensive in the US. And so you really want to make sure that it's something you're committed to doing before you really bring in that talent. And I think hiring local talent is probably one of the most important things, I think, in getting a market like the US, right? It's so different. It's so nuanced, as we've heard today. I think that was one of my key learnings from Revolut, where maybe we started expanding from an HQ, but you really realize each country is so fundamentally different. You really need someone that knows that market inside and out, especially as your first boots on the ground, before scaling. So I think, yeah, that's one of my key things, I think, would be really make sure you want to do this before you hire, and not just hire before you want to nail the market.
Yeah, no, I suppose that's also one of the most difficult one, because if you don't have a well-known brand, I mean, we know Klarna, for example, when they moved to the US, they didn't, and hired people which weren't the best for the company because no one really wanted to work for them before they knew who Klarna actually was. I mean, I think this is quite an interesting walk around, like how do you actually expand, and the difficulties. And
Absolutely.
I mean, yes, Hal.
Just about expanding employees in the United States, it's also recognizing what job functions you actually need there. You don't need to replicate your whole org chart in the United States just because you're in the United States. You could probably keep all of your back office functions at home. Maybe you just need a salesman in the United States. Maybe you just need a marketing team in the United States. So it's really identifying what are my absolute needs in the United States to expand there, and just do that. You don't need to replicate everything you're doing in your home country to come to the United States. You don't need the whole org chart.
Yeah. Apart from, you need to probably have the tax consultants.
Yeah.
That's, well, anyway, I can see here that I will see if we have one more question, and then yes. So Tom Smith has sent in a question: is sales tax in the US needed to be kept in a segregated account before remitting to tax authorities? In the 100 plus $6 example, would the business have access to the full 106 until the remittance of the 6, potentially a Visa cash?
Yes.
Yeah.
Yes. You get to use that $6 until it's due to the jurisdiction.
Yeah. Okay. So Tom, that's your answer. And yeah, no, I think that's actually, we have one more. We have time for one more here, and it's from Keith. Any thoughts on the key issues to take into account when considering whether to enter the US market via distributors, agents, versus setting up a wholly owned subsidiary US legal entity? I think we spoke a little bit about that, Hal, right?
Yeah.
But what do you think?
Yeah, I think it really depends on how much control you want, in the United States. Obviously, you could always use a distributor, a vendor, an agent to sell your product, but then you're also relying on this third party to sell your product. Are they going to give it 100% of their attention? Are they going to market it exactly how you want it marketed? If you set up an entity in the United States, you would own that entity, you would have more control. But I think it really depends. Using a vendor when you first come into the market may be a good idea. If there is a vendor who has success driving a product like yours before in the United States, that could absolutely be a more cost-effective way to move into the United States rather than jumping in, creating a company and hiring in the United States.
Yeah, so Viraj, what do you
agree.
think? I mean, it's the same from a VC perspective.
Yeah, absolutely. I think Hal hit the nail on the head there. That's exactly what I was going to say.
Great. It's nice when you all agree. So, well, with that, I just want like to thank everyone who attended, both the people attendees, but also a great panelist for this really exciting Sifted talks. I mean, I learned so much, which I usually do when it's about, especially about taxes. I mean, and like going to the US. It's really interesting. So thank you so much for coming, and thank you so much for our partner Vertex as well for your support. And
Sure.
I do think we managed to do all our questions as well, which is great. And yes, and going to sifted.eu to check out our next Sifted talks, which are coming soon. So thank you so much for joining me today.